avoid any stock that everyone is talking about, like Tesla or Palantir. Normally, if people are on TV recommending something, it's probably a bad idea. And some of them, even if they are a good idea in the abstract, when you get down to the specifics, there's a certain price where you pay something and it's no longer a good deal. So, you can pay a great price for a terrible company and make money on it, and you can pay a lot of money for a great company and lose your shirt. So companies like Tesla and Palantir that don't make any money and people are pumping because of hype about AI or anything like that, you should avoid like the plague. And I'll just use Tesla as an example, and then we'll go into some other ones. But Tesla is worth over $1 trillion if you go by the market cap. And if you go by the earnings, the PE ratio, it's trading at 185 times earnings. So you might have seen the news where Tesla sales are down in their main markets like California. It was growing in Europe, but now it's dropping in every European country. In Germany, it's down like over 50%. In other countries that have had EV adoption, like Norway and France, it's down a lot also. So you are paying 185 times earnings for a company that is shrinking. So if the company stayed this size and kept making the same amount of money, it would take you several lifetimes to make your money back because it's trading at 185 times earnings. So if you owned it and it kept making the same amount of money and wasn't shrinking, it would take you 185 years to get your money back. However, it is not staying where it is. It is shrinking. Sales are down in the US, sales are down in Europe, and even this 185 times earnings is deceptive because if you look at how much money they made, here we go, net income 12.7 billion. That's deceptive because of a change in the accounting rules that they passed recently, which is very controversial, where the assets like stocks and things like that that you have on your balance sheet, you have to mark them to market. And if they go up, you report it as income. And if they go down, you report it as a loss, which is ridiculous. So a company like Berkshire Hathaway that Warren Buffett runs, if the price of Apple goes up a lot in one year, it gets recorded as income. And if the price of Apple goes down a lot, it's recorded as a loss. And it is not income. And if I asked you how much your house is worth and you told me it's worth X, and I said, well, how much did you make last year? And you said, well, I made 100,000 in my day job and my house went up 200,000. So my income for last year was 300,000. That's ridiculous because you can't spend the amount of money that your house went up. And if I said, well, how much did you make the year before that? And you said, well, I made 100,000 and my house went down 150. So my income that year was negative 50,000. You could not report that to your IRS as, negative income because they would put you in jail. But the accounting rules were changed such that uh, the stocks and cash and anything else you have on your balance sheet, uh, when that goes up or down, doesn't only affect your book value, but it affects your income, which is ridiculous. And Tesla owns a lot of Bitcoin, which is why Elon Musk is always pumping different meme coins and things like that. And last year, their Tesla Bitcoin holdings went up 600 million. So when you see that 185 times earnings, that 100, it would take you that long to uh, get your money back. That includes 600 million of Bitcoin earnings. So, that is not income that came from the car company. That is income that came from Bitcoin. And you're still paying 185 times that number. And for a company where the sales are going down and he's alienating people in his key markets, people in California are very green and they like EVs and he's pissing them all off. Germany sales are down over 50%. France, they're down like 40%, and Norway down. So yeah, this is a terrible company, and people keep pumping it up. And I will not invest in companies like these. I invest in companies that you never heard of, like uh, pets.com, which I did a video on. And if you subtract the cash and real estate, you're getting the business for free. I invest in companies like Kraken Robotics, which is up over 100% this year. And I may do a video on this. Venture Global, that's an interesting one. Just took a position in that. But again, just a reminder, avoid the popular stocks, avoid the meme stocks that everyone's talking about. Even if you think it is a great company, don't pay an infinite amount of price for it. You still have to sit with the pencil and paper and figure out how much you realistically would pay for this company and how long it would take you to get your money back. At 185 times earnings for a company whose sales are going down, where the CEO isn't there because he's busy doing stuff in Washington, and he splits his time between this and Twitter and a sort of rocket company and whatever else he's doing. 185 times earnings for a company where sales are going down and a big part of their earnings is Bitcoin. I would stay the hell away from that. Anyway, and that brings me to another one. This is just an example. Teladoc. So during the height of the pandemic, when people couldn't go to see doctors because they were afraid of getting COVID, companies like this and Peloton went through the roof. So Peloton made little bicycles that everyone loved because you can work out at home, and Teladoc allowed you to see a doctor without, having to go and wait in the waiting room and be around other sick people. And at the time, people like Jim Cramer, who's terrible, and Kathy Woods were heavily pumping the stock. It was over $200 a share. I think it got high as almost $300. So if you had listened to them when they said this is going to 10x from here, and this is the next whatever, the next Amazon, you would be down. Yeah. Well, it's over 5 years, it's down 90%. But if you had bought it at the high, you'd be down like 95 or 97%. Listening to Kathy Wood and Jim Cramer on TV telling you to buy something. If somebody is on television telling you to buy something, stay the hell away, because they're telling you, they're telling everybody, and it's not going to end up well for you. So 90% plus off its high, and now it's a $1.8 billion company. And to put that in perspective, a few years ago, they paid $2 billion to acquire a company called Livongo, which went horribly, and the whole company is trading for less than that. So yeah, and they still have debt, and they're still not profitable. If you look at the balance sheet, it will say that they have free cash flow and they can grow into that. Over all this time, they haven't grown into profitability. And I think the free cash flow is an illusion because they are hugely dilutive. They issue lots of stock options to employees and management and everything like that. And if you had paid those people in cash instead of stock, you would have no free cash flow. So this company does not make any money. Stay the hell away from it. But when I was looking at this one, I did turn up some interesting things, and I may do a separate video, but I'll just throw them in here. This one is a company called Amwell, and it looked interesting for about 5 minutes because the company itself trades for $168 million. But if you go down, they have 245 million in cash in the bank. So you could buy the whole company for 165 and they have 244 million. So it's like paying $100 for a cash register and there's $200 in the till. But there's a problem that a famous investor called the pickles in the jar. How do you get it out? And this company has been losing money for its entire history, still can't make a profit. And last quarter they lost 30 million. I think last year they lost like 100 million. They'll claim they'll be profitable by 2026. And if you believe them, okay. But if they're not profitable by 2026, that's 54 million in cash. The company's worth 168. They have some debt, right? Yeah. But anyway, with 244 million, 167 debt, that's a net 67 million. You could buy the whole company and you'd still have 67 million left over if you shut it down and just paid yourself. But you don't. They want to keep running it. And within 2 years, if they're losing $100 million a year, this is going to go away. This 200, most of that's going to go away because they're losing 100 million a year. And if they're right, if they turn the corner in 2026, maybe you'll make money, but uh, they have not been right the entire time they've been operating. So I wouldn't take their word on that. I did find a couple of other ones that I'm sort of studying, and I bought small positions in that looked interesting, at least more interesting than those. So this is Talkspace, and this is a competitor to one of the subsidiaries of Teladoc called BetterHelp. So BetterHelp is a online service where you can talk to psychologists. However, with BetterHelp's version, which is owned by Teladoc, they don't take insurance. Talkspace does take insurance, and they have sort of three uh, ways they get customers. One is individual people who find them and call up and just pay themselves. And that part is shrinking, which is fine because it's not a great part anyway. That's the part that BetterHelp focuses on. And they have sort of these employee assistance programs that different corporations have for their employees, and those pay Talkspace a monthly fee, and you can use it or not use it, but Talkspace gets their money. And then they also have partnered with people like Amazon, where you can book the service through them. And they were losing money. We're losing money, just like Teladoc, but they turned profitable last quarter. So it could be interesting if it keeps growing because they keep acquiring better corporate gigs. Like they just signed a contract with the Navy, and if that gets renewed, those military contracts can be very profitable. And if they keep signing up people like Amazon and other things and keep them as clients, it can turn really profitable. And this company, the whole thing is trading for 572 million, and they have no debt. Well, they do have debt, but they have more. Uh, Sorry, no, they don't have debt. Yeah, so 100 million in cash, no debt, and it was losing money, but now is profitable. So it's in the same sort of boat as pet meds, where they were losing money, but now they're profitable. This one was losing money, and now it's profitable, and it looks a lot better from here going forward because a company like Teladoc was losing money and still is losing money, and a company like Amwell was losing money and still is losing money. So this one has no debt, has a lot of cash, and if they're making money now, that cash isn't going away, and you can sort of, if things go right, you can do well from there. This one's also an interesting one. It's called LifeMed, and it's kind of similar to HIMS. So HIMS, let me pull up HIMS. HIMS is actually doing really well, and every time I looked at it, it always looked too expensive. But HIMS does, they started out doing ED pills for men like Viagra, and people would go on there because if you want to get an appointment with a specialist like a urologist, you'd have to, it's a wait time. You got to go through your HMO and blah, blah, blah. And it's a big pain. And this one, you just go online. They have people there. You did not initially pay through your insurance, but they would see you right away, and then you'd have your pills in the mail. And as they grew, now they started taking insurance, and they went from only selling uh, pills like Viagra to Ozempic and those GLP-1 drugs. And that's sort of where when they got approved for that, sort of skyrocketed here. And yeah, so that's where it started going up. And also, they're doing something now where they are opening their own pharmacy so they can send people the drugs themselves instead of going through someone like CVS. And then they keep more of the order, what they call the take rate. So that's a very profitable business model, and it is now a $9 billion company. And LifeMed is interesting because they do that also. So they have only a $260 million market cap. So it's a lot smaller, but they were in the same boat where they were losing money, losing money, losing money, and now it looks like they're about to become profitable. And I did mention their preferred shares, which pay a nice dividend. But the interesting thing about this is they're sort of following the blueprint that HIMSS did, where you have these um, uh, sort of customers who come to you. They were looking for Viagra, and now LifeMD sells them also GLP-1 like Ozempic for men and women, and they do other things like stuff for hair loss and whatever. So a few different revenue streams for 268 million. It looks interesting, especially if we go here, because if you notice, the enterprise value is less than the market cap. So that means uh, either it has no debt or it has more cash than it does debt. So if we scroll down here, you'll see that yes, they do have 25 million in debt, but they have 37 million in cash. So more than enough to be considered net debt free, right? And because they are going to be making money next year, if you look at the forward earnings, the trailing earnings is how much they made last year, which they didn't. And forward earnings, people, the analysts look at this and they think this is how much you're going to make next year. And the consensus is that it's trading about 27 times next year's earnings. And if you go to HIMSS, which I said is very similar, but a bigger company, and you go to the statistics, it's trading at 95 times this year's earnings, so half as cheap as Tesla. And if you go to next year's earnings, it's trading at 86 times what they think HIMSS will earn next year. So 86 times next year's earnings versus 27 times next year's earnings. And what's interesting about this also is that right now, LifeMD is only in 32 states and they want to expand to 50 states. And they were not operating their own pharmacies like HIMSS was, but it turns out the pharmacies are very profitable. So they're getting into that. So that's kind of two growth drivers that may drive this higher. So normally 27 times earnings is too rich for my book, except for a company like Google or something like that, which is a great company. But I think with these two uh, things operating in concert, going from 32 to 50 states, starting to operate pharmacies, and going from losing money to making money, I think people will notice this, and either the stock will inflect or maybe they'll get taken over by somebody bigger. So HIMSS is a $9 billion company, and as I said, this one is 200 million. So HIMSS has more than enough cash to buy these guys if they're doing a great job, or somebody else might buy them. So just speculating, but yeah, so generally, if you see something that is way overpriced and people are hyping it on TV, stay the hell away. Sometimes in the ashes, you can find interesting things. So Teladoc was $200, $300 a couple of years ago when Jim Cramer was spouting it. It's still not cheap enough for me now, but from looking at Teladoc, I ran into these interesting ones like HIMSS and LifeMD and Amwell, and there may be something there. Uh, you know, this isn't a recommendation from me. I don't give recommendations. I don't give buy advice. But this is just me walking through my process and how I like to look at things. And this was my process for looking at Teladoc. And when I saw that it was down 90% plus from its high when Jim Cramer and Kathy Woods were recommending it, uh, it just reminded me of other companies like uh, Peloton that also got killed, and companies that are ridiculously overvalued like Tesla and Palantir that people are still recommending, and I think will end badly for them. So that's the lesson for today, and also the lesson: uh, you should not want to do this for a living, and if you do, uh, you should pray that you are never called the next Warren Buffett, because whenever somebody calls you the next Warren Buffett, it's a curse. You underperform or implode. So there's a guy called Jerry Tsai who, in the 60s or 70s, was uh, touted as the next Warren Buffett, and was putting up just as good numbers as Warren Buffett, and was investing in the equivalent of tech companies at the time. The paper came out and said he was the next Warren Buffett, and within a couple of years, his fund had collapsed and lost most of his money, and he ended his career running a can company, a company that makes cans. I am not making this up. And his son is now an investor also. Jim Cramer, before he became a joke and on TV, uh, was running a successful fund, and they called him the next Warren Buffett. And then his fund crashed, he lost all his money, and now he is a clown on TV, pumping stocks. And his picks are so poor that you could make money by doing the opposite of what he said. And I'm not making this up. You can Google this. Somebody launched the reverse Cramer ETF, where if Jim Cramer recommends a stock on TV, they will sell it. And if Jim Cramer recommends to sell a stock, they will buy it. And the reverse Cramer ETF has outperformed the index by miles. So, an interesting thought experiment. What if the reverse Cramer ETF continues killing everything, and Cramer comes out and says, you should buy the reverse Cramer ETF? What would happen? Would the world implode? I don't know, but I don't want to find out. But yeah, so Jerry Ty crashed, Jim Cramer crashed. There was a guy, Eddie Lampert, who they said was the next Warren Buffett. And the next thing he knew, he bought Sears and some other company, and has been losing money for the last 10 years. Kathy Woods, who fund was up over, I think, 200% in 2021 because, she had invested in companies like Peloton and Teladoc during the beginning of COVID. Um, they called her the next Warren Buffett, and within 6 months, uh, her stock fund tanked. I'm trying to think of a few more. Yeah, so uh, do your own thing. Try to be the next you, not the next Warren Buffett, because it turns out being called the next Warren Buffett is the kiss of death. So you should not wish for somebody to call you that. Anyone. In today's lesson, stay away from the high flyers, stay away from Tesla, stay away from Palantir. If anyone on CNBC is telling you to buy it, it's probably a bad idea. If it's something that you've never heard of, but you understand it, you have a better shot there. And, I don't know why you would pay uh, almost 200 times earnings for Tesla when uh, it is a company that is shrinking, when a company that is growing like Crocs, you can get for 7 times earnings. And, this isn't a recommendation for Crocs either, but, I'm sure you don't understand what Palantir does because nobody understands what Palantir does. But I understand what Crocs are. I'm wearing one pair now, and, it's uh, injection molded foam rubber into molds, and people put it on their feet. That's very easy to understand. A lot of people on CNBC are telling you to buy Palantir because of AI, but I'm sure there's people who work at Palantir who couldn't tell you what Palantir does. So uh, stay away from companies that don't make any money, are trading at ridiculous valuations, and people on TV are telling you to buy it because they probably have an agenda. Anyway, that's my rant for today. Have a great day, everyone.